What is up, guys? It is Joe Caruso here with another trade breakdown video. Now, for today's breakdown video, I'm going to go over a trade which I called inside the Trader Society Academy Discord earlier last week. I believe it was on a Wednesday, and the trade got triggered Thursday, so there was actually plenty of time for everybody to take it. I gave the game plan out the day before. Now, to cover the background of this trade, it was definitely fundamentally fueled, which was an additional confluence, which I really liked. I love to be able to have a trade that lines up with the technicals, lines up with the indicators, and lines up with the fundamentals. So Wednesday of last week, we had FOMC, where the Federal Reserve rose US interest rates by another 0.25%. Now, an increase in interest rates will typically lead to a stronger currency. So since interest rates were raised, I was expecting to see dollar strength. So I'm going to start off on the weekly time frame. Noticing on the weekly time frame, I was able to get a creation of a trend line all the way to the left, a first touch of the trend line, and we were looking for that second touch of the trend line, which we hadn't completely reacted off of. Now, the trade I called was on this third candle, which was touching this trend line. So due to the fact that the weekly was actually wicking off this area for 2 weeks, but still hadn't played out, the fact that we had 3 weekly wicks within that area, it was the third week when this trade was called, I like to see that there was a rejection going on these higher time frames in that area. So we had a weekly trend line touch. Overall, this market was bearish, but we came down to a powerful weekly trend line, which had a rather strong move last time it was hit. A very similar situation. Bearish market, hit this trend line, completely flipped to the other side. Now we came back to this trend line in a bearish market, looking for a move off that area. Going to the daily time frame. Now, because this was against the trend, I would never want to take the trade on the first touch of that area because we were creating new lows. So what I like to see was the fact that the daily created a bullish Sharkfin. Our TDI was below the 25 level rather considerably, and we were outside of the TDI Bollinger bands. Very clear Sharkfin. The shape is obvious. It's very easy to cite. So we had the daily Sharkfin. We pushed off that area. Now we rejected off of a spot that didn't make a lot of sense. Now, following this strategy, I know that when a Sharkfin is created, and price comes back down to that area, and that Sharkfin really hasn't played out, I'm immediately looking for divergence. Notice that this wick that came down, which was exactly the daily wick in which we entered the trade, and as I called it the day before when we were slightly higher up, the previous daily candle. This wick was slightly below the actual low that was created. So I am reading this as Sharkfin turned divergence. Where our Sharkfin happened, we had our little push back into the market. Price came back down, essentially wicking out, creating a deep, deep divergence, ever so slightly. You'd have to actually hop on a lower time frame to draw that trend line connecting to that area. Now, I took profit where I did because it was Friday. The trade played out pretty much in a day. It rose close to 1,500 pips on USDCHF. The final target was going to be up here, but I was more than happy with capturing almost a full 1 to 3 on this trade. It was a 1 to 2.5. The way I gave the trade call out, I took 2 positions on the trade. I closed out of one slightly in profit. I'll hop on the lower time frames and show you exactly how I did that. But that was the confluence on the daily. Sharkfin price came back down a little bit lower to create deep Sharkfin divergence at a weekly trend line. Now, we were looking for as many confluences as we possibly can. our 4-hour Bollinger Bands had flattened out on the bottom as well, a telltale sign of a potential reversal happening and a slowdown of momentum in that direction. As we could see, when price was falling fast and hard, Bollinger Bands were steep like a slide. Now, when our bands got very wide, we know that that is also a precursor to the flattening out of the Bollinger Bands. So our bands got wide, then got relatively flat as we created that push down, which created a 4-hour Sharkfin at our entry area. So the exact way I managed this trade, I did take a slightly earlier position that was about 30 pips higher. So the trade got triggered. I was in it. Price came even lower. I loaded up on a slightly heavier position because now that trade had a smaller stop loss than the trade I took earlier. Stop loss was at the same area, but since my entry was 30 pips lower, the trade had a 30 pips smaller stop loss. So I was able to take a larger position than I did on the first position. It makes sense to take a larger position at the best placed spot. And this was the absolute best spot. If it did not react here, you really didn't have to give it too much room to figure out that that area was going to break. This 4-hour Sharkfin played out beautifully, as they tend to play out when you have higher time frame confluence. Daily Sharkfin creating divergence, weekly trendline touch, 4-hour Bollinger Band touch, 4-hour Sharkfin. These moves that line up on the weekly, daily, 4-hour will tend to also play out very fast. And I do think we are going to come up and tap that 4-hour 200 moving average. Our daily 50 is also up in that area, as well as clear market structure for sells. If I keep going, that is that zone is. If I zoom out a little bit, you could probably see it better. We definitely have potential sells lining up there on the 4-hour and the daily. There's a trend line there. That was going to be the final take profit. I know since it was Friday into Sunday and even Sunday into Monday, the market will tend to be a little bit slower, and that will also bring those moving averages down. So I was more than happy to take what we got on this USDCHF trade. The entry that I got in on was also a 5-minute Sharkfin divergence with flat Bollinger Bands. This is another great example of how you want your Bollinger Bands to look, and when the more time frames you have this happen on, the better. This is absolutely great when it looks like this. You have your Sharkfin happen on the 5-minute right over here. Price comes lower. TDI went up a bit, so we were starting to create divergence, but we didn't touch the 2.0 Bollinger Band yet. The 2.0 is the band that is closest to price. Now notice what happens when you get Sharkfin, because this was an exact replica of what we saw on the 4-hour. So your 4-hour and 5-minute, we're doing the same exact things with the Bollinger Band and the same exact thing with the TDI, where divergence was being created. Again, our Sharkfin is here. This is the highest point on our TDI at the lows. We have this Sharkfin. Lowest point on the TDI. Price goes down, TDI goes up. Now, Bollinger Band's flattened out. Price comes down to touch that area, which is what I was essentially using for entry. I would have gotten in actually pretty much at the very low. Those of you guys that are in TSA, you know our entries tend to be nearly perfect because we wait for things to line up like this. It is not by chance. It is not by luck. There is a science behind it, and it's called multi-timeframe confluence. When you wait for confluences with several indicators on several time frames, when all of it lines up together, you have an amazing trade and you can find an amazing entry. Because when price came and touched this Bollinger Band on the 5-minute, it was gone. You got in around that area, whether it was at the retest of the low that was created. Just like on the 4-hour, I wasn't looking to enter immediately when something is coming down. It's actually so much better to wait for a low to be established, especially if you're doing it on a lower time. Higher time frame might look like it just comes down to an area, takes off, but your lower time frames, you will almost always have a chance like this where a low gets created and it essentially gets respected, or a slightly lower low gets made. And this is where we know how to enter because we use Bollinger Bands. Flat Bollinger Bands with divergence on your TDI is the green light for that trade. Green light. Even in scenarios where the trade doesn't play out, you will still almost always get a rejection off the divergence at flat Bollinger Bands. Now, when that goes on inside of a higher time frame trade, you get a sniper entry, near perfect entry, and you tend to get a trade that plays out rather fast. You can see based on these 5-minute candles, the size, the volume of these candles, it essentially launched off during New York Open, that's exactly where these candles started to get large. We had FOMC. Here's the fundamental aspect of what happened. I hop on the 1 hour. We had FOMC happen. I'll take the Bollinger Bands off just so it's a little easier to see. FOMC happened on Wednesday at 2 p.m. Right over here. Interest rates were raised. Jerome Powell was speaking. His speech was a little bit unclear. And at first it looked like the market was reacting to a dovish Fed meeting. But essentially all it was a pullback. It was a pullback to a liquidity area. So it was a liquidity grab with a little bit of a stop hunt because we did actually break the previous lows. And that's where the divergence on the higher time frame I was talking about, that 4 hour, did actually sink under the previous lows by a little bit. But the Bollinger Bands, the Sharkfins on the 4 hour and the daily, the flat Bollinger Bands on the 4 hour, the 5-minute, was what gave me that confirmation signal that trade was still valid. And that's where the exact entry was. The 5-minute, the 15-minute, the 30-minute, those lower time frames will often help you get the best entry possible. Notice what the Bollinger Bands are doing. Once you locate an area, once you zone out an area and you could say, hey, there's about to be a daily shark fin. Let's see what happens once we come into this zone. You come into the zone, you start checking your lower time frames. You're seeing divergence, flat Bollinger Bands, or shark. You know what I mean? Once you get the lining up, you can realize like, okay, where's the 30-minute Bollinger Band flattening out at? And if that's the time frame that's giving you flat Bollinger Bands, you just have to make sure you're lining up the trade with higher time frames. That is the absolute biggest factor, and that is the deciding factor between, I would say, a 50% win rate and an 80-90% win rate. Because in TSA, we've maintained over an 80% win rate for almost 8 months. Probably close to 8 months. We've gone months without losing trades before. We've gone almost all of July, I think, without a single loss. There might have been one in the very beginning of July. But December, all of January, not a single loss was called. You can ask anybody who was in TSA for that 2-month period. Not a single loss called. And we called a couple of trades a week. This strategy is rather unbelievable, but you have to have patience. You have to have discipline. The patience comes in to be able to identify higher time frame areas of potential confluence, whether it be where a weekly moving average and a weekly fib level, weekly trend line is all coming together, and then waiting for daily to give you a signal as well, or the 4 hour. You have to find these areas. You have to have the patience to wait until these areas get hit. You cannot chase the trades. You cannot force areas by just hopping onto a lower time frame, being like, hey, here's a support that should become a resistance, and hope that works. This strategy works so well by waiting for the higher time frame areas to get hit and then scaling down through multiple smaller time frames. The discipline comes in. The discipline is where you analyze your multi-time frame analysis and check your indicators on different time frames. Check your TDI, your Bollinger Bands, your moving averages, and use your discipline to make the logical choice. If things do not line up the way you wanted to, it doesn't matter if you waited 15 days, 20 days for that area to get hit. If price hits that area and none of your other confluences are there. There's no Sharkfins, no divergence, no flat Bollinger Bands. Things are looking ugly. Price action is building up against you. You don't take the trade. That tends to be what we do. Doesn't matter how long we waited on it. If things do not look great, the win rate starts to deteriorate. It doesn't mean the trade's not going to play out. What it means is if you're not very disciplined, you're going to take a lot more losses than you would have if you were disciplined and you waited. For this USDCHF, I felt like I was really waiting. I was also waiting on FOMC. That was why I also didn't trade in any other area as price was coming down. I like that we created a low. I like that the daily was a Sharkfin divergence that had not hit the 50 yet. To me, that's a huge thing. A huge thing. That's a very common rule that I use. A divergence will almost always get you to the 50 moving average on that time frame, especially if that 50 MA, which is my blue line, is lining up at an area of confluence, is lining up at a fib level on the daily, is lining up with the trend line on the daily, is lining up with support turn resistance in a bearish market on the daily. All these confluences lining up against me here, most likely we are going to come into this area. Very, very, very high probability. So when I saw that the daily only came up and hit this 236 level, but nowhere near market structure, I'm very big on following market structure. So I knew it made no sense for us to just drop from here and create a new low, especially when we had this Sharkfin and our TDI on its way down was so high up. We had a couple candles that rose and our TDI was flying up already. That let me know that we were setting up beautifully for divergence. And as soon as we came into that area, it was looking great. 4 hour gave a Sharkfin. Again, multi-time frame analysis, the patience to wait, find the area, wait for it, the discipline to say, okay, X marks the spot, just checking off the boxes, boom, 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 boom. This is the spot. Everything looks good. Green light. Okay, we're in this. Goes against us a little bit, add another position. Because I located the two areas, I gave 2 different entries for everybody, a full over 24 hours in advance. We had about a day and a half because I let everyone know that I was waiting for FOMC. And the perfect case scenario happened. Perfect scenario with fundamentals is that market goes the opposite direction that it should. You should know that almost any time interest rates are raised, that currency will experience strength against other pairs. Now, there are scenarios where the Federal Reserve, or if it's the ECB, or different countries have different names for the central bank and who runs the central bank. Now, if they are speaking and they are talking, what they're speaking about can have a heavy influence on the market. Just as much as the rate can have, sometimes their speech can have more of an impact than the rate, because what they say has to do with the future of interest rates. So if he says, hey, we're done raising interest rates for the year, that's going to have a huge effect, even if regardless of whether he raised them, or people actually react more to what's to come, because the market is always trying to predict what's going to happen next. So the raising of interest rates was already well predicted. It has been predicted, I would say, for a month or two now. Everybody knew that they were going to raise interest rates by 0.25%. All the experts forecasted it. Jerome Powell was basically implying it at the last Fed meeting. We kind of knew that was going to happen. But then during the speech, he didn't really give any type of hint that this is definitely the last one we're going to see, which means they could raise rates further this year. So they raised rates. USDCHF should have gone up. We just kept on pulling back, and this trade was too good to not take, and I knew we were going with the fundamentals. For me, this is a picture-perfect fundamental trade where the technicals, the indicators, and the fundamentals all lined up. Perfect scenario. The only thing that wasn't perfect was the overall trend of the market. We were catching a buy, which is essentially a pullback for the sell because we are in a bearish market, but it was easy to pinpoint where this buy was going to happen at, and it basically just fell into our lap. I knew fundamentally what was supposed to be going on. It was overall a great trade. Thank you guys for watching this trade breakdown video. I'm going to keep up with these and continue to do about one a week. Let me know in the comments, guys, what other types of videos you would like me to do. I'm very close to being almost maxed out in funding with the Funded Trader. That should happen in a couple weeks. Just recently got a 300K funded account, and I have another account that is on phase 2. So within the next couple weeks, I'll update you guys on it on newer videos. Should be very close to maxing out funding soon, and it should happen. Now, let me know again if you want me to cover prop firms, if you just love the trade breakdown videos, if you want me to cover trading psychology, if you want me to cover how I mark up, doing like a Sunday night breakdown or analysis. Let me know if you want me to do something like that, where I go through a bunch of pairs and show you how I start from scratch and mark it all up. Let me know. Comment on the video. Let me know what other types of videos you would like, or contact me on social media. My Instagram handle is the Joe Caruso. Again, thank you guys for watching, and you will see more of these with the weeks to follow.